Thanks everyone for coming and joining today. I'm Charlene. I was a former product manager at Google, and I'm now a founder of Distillable, where we work with experts to unpack their insights into products, books, events. Steve is one of our experts on fundraising, and he has a lot of experiences around advising startups, understanding investor psychology, negotiating, building the optics and momentum for your startup. So I will just let him take over and share a bit more about the insights today.
Awesome. Thanks, Charlene. And super excited to be here. Really humbled to be with this group. I can tell it's a lot of intelligent people on this call. And it sounds like you guys are working on creating solutions to serious problems in so many different areas in the world. So, as Charlene mentioned, my name's Steve Femino. I've worked with startups for, I say 10 years, but it's really been closer to 15. But with anything, you just start to get into a specific space and start to feel your way out and mature into being an expert of a field. So, my background's originally in finance, and it moved into like venture creation, venture strategy. And I started working with startups when it was just in an advisory role. So I'd work at some different incubators and whatnot and just help out as an advisor and mentor. And I realized that there was a need for understanding, finance strategy. How do you put together, whether it's two engineers and a good idea, how do you turn that idea into a business, right? And how do you get the funding to build that business? So I found that it's just like a common issue out there that a lot of startups are struggling with. And then as you start to learn about fundraising, there's a ton of material out there on there, like a series B, C, D, if you want to take it public with like an E or an F. There's lots of content out there, and it actually makes sense. So there's a lot of content out there because there's a lot of people making money off those transactions, right? And wherever there's money to be made, people are more willing to share information so that you use them in that transaction. Think about how much money the bankers make when a company goes public. They make money whether or not the stock does well, they make money on that transaction. So I've found that there's a little bit of a dead space out there from really pre-seed to series A on how do you actually approach it? And as you get earlier in the fundraising process, everything becomes like a one of one situation. But one thing that I've noticed is that as you take a step back, if you start to think a little bit from a more macro perspective about why fundraising exists, why early stage investors exist, such as angels, angel syndicates, or even an early stage VC, you really start to understand and see some commonalities around the space. So I've actually recently started my own consultancy called Startup Funding Advisors, where we work with early stage companies that have a high likelihood of getting funding so that they can actually get from where they are to where they want to be. And usually funding is the tool that gets you there. But one of the most common pitfalls is founders saying, oh, if only I had the money, then everything would be fine. And that's usually where the first and fastest route to not being able to get funding, because most investors know that if you just throw money at an issue or a challenge, that means you really don't understand exactly what needs to happen. So what we're going to cover today, and this is just a sub-segment of the book that Charlene and I worked together to put together on Distillable, focusing on early stage funding. So we've got a couple topics from the book, but again, I want this to be conversational. So I've got some topics we'll cover and we'll dive into, but I'd love for you guys to ask questions on, I'm not sure what you mean, Steve, or could you tell me a little bit more detail, or tell me a different example to help you understand it more? The three areas that we're going to get into today are importance of investor alignment, some strategies for building investor relationships. And again, this is captured in that pre-seed to series A range. And then the understanding the impacts of investors by investment stage. And those impacts are both positive and potentially negative. So what we're going to do, and what you'll see is kind of a theme here, is most things operate on some sort of a spectrum. And what I like to look at is, from a macro perspective, what are those binary outliers? So what's like the best investor ever going to look like? And then what's like the worst possible investor going to look like? You're going to land somewhere in between. It's very important to understand those binary edge cases so that we can really understand why we're going out and fundraising and then what we're looking to accomplish with that. Because believe it or not, every person, even on this call, might have a different purpose and reason for fundraising. So to get us started, I kind of want to ask a little bit of a engaging question to see, just to get everyone going and to see where everyone's at. But a question that kind of comes up is everyone thinks about fundraising and says, oh, I always want to fundraise. I always want to get money. But could we talk about, and I want to hear from you guys first, and I've got an interesting example I'll share, but when might you not want to take an investment? Said differently, when might you not want to take money? Could anyone get us started here?
It's sort of the dilemma actually we're facing right now is, prior to this contract coming up, we were planning on a small pre-seed round, maybe 500,000. This contract puts us in a different position, and now we have the option: do we raise a couple 100,000 from angels, keep more of our equity, or do we try to blow it out and go and raise a seed round in the millions? Literally what we're thinking about right now. So, perhaps we don't try to raise, and maybe we can leverage this contract for other big contracts from districts, and maybe we can work off our revenue, not have to raise. That would be ideal, but I'm not sure.
Yeah, perfect example. We can talk about your specific case a little bit later on. Anyone else have one that you'd like to share? Doesn't have to be just about you, just a situation that you can think of.
Yeah, the way I've been thinking of it is, when does a round reduce your options rather than add to your options? When is it force you down a path that may cut off some options that could be more viable?
Another great example. Love that one.
Yeah.
How about one more?
I think if there's a potential that down the line that the founders would be too diluted. So you kind of have to think ahead in terms of, at each round, how much dilution do you expect and what is it going to take for the specific exit that you have in mind, whether it's acquisition or IPO, or if you actually want to stay private. That's also always an option that's available. So
yeah, that's another great one. And that's something that a lot of early stage founders don't necessarily think about. They think about, okay, I got the money, like, let's go. And then don't think that, okay, is this enough money to get you to where you want to be? And then you just go and keep it kind of private, keeps it, you got a good group of investors, you keep it kind of private, you keep paying them out. And we're a private company doing, moderately well. And we don't need to be that unicorn. Again, not every startup needs to be a unicorn. So I just have one example I want to share with you guys. I promise this is the only time I'm going to share my screen, but I find this visual very useful. And it's a situation that I've actually seen happen a number of times. Which screen am I sharing here? Charlene, is that
we got the right one.
Okay, you got the right one. Excellent. So what I'm showing here is just two lines here. One's your revenue, over a number of years, and one's, your valuation. And for this example, we're just saying, say valuation's 3x revenue, where you might want to take an investment in like year 5. Usually investment in the first couple of years, it's pretty binary. You say, okay, we need the money or we're going to shut down. In Eric's case, this might be an opportunity. Hey, we can extend our runway with a great new customer, new contract, and that's great. We can push out, we can get a higher valuation. That's even better. But in this situation, this would be something where you might be raising a Series A, a late Series A, or Series B, and you see investors come in. And when investors come in that stage, especially when it's later B, maybe even C, they're looking for a specific return. Where you might take investment in year 5, but you might have some people coming in that might be talking about an acquisition. So you take that investment in year 5 and say that's about a $20 million valuation. You're then say you raised, say, $5 million at say about a 25% with a $20 million pre-money valuation. You might get an offer to be acquired for $25 million. Now, as you, the founder, you're 5 years into this. You might say 25 million, say you still have about 50, 60% of the company left. Okay, that's a great payout. I want to take that. These investors might get together and actually block your acquisition because they might get together with the other investors and say, hey, we could go here. This is where we want to go, this target exit in year 8. And you might be thinking, I'm 5 years into this. I don't know if I can do this for 3 more years. So this is a really interesting situation where you might actually get an opportunity to get acquired, but for those investors, they might only be getting a 25-ish% return. And for their investment perspective, that's not enough for them and they want more. So they might push you to have to actually run this longer and grow it more to where you might be ready to take an exit. So an interesting perspective, doesn't always work out like this, but again, taking money isn't always the best idea. Omar, looks like you've got a question here.
Yeah, I just want to understand when you say that they can get together, the mechanics of that would be through board seats. Is that correct?
Well, yeah, it would be through board seats, but it's also voting control. So it depends on what types of shares everyone has, if they have voting shares or non-voting shares. And it's, that venture capital organization, if they say they own 25% of the company, and those are all voting shares, that might not be enough, but they might get together with the other investors and say, hey, listen, like there's more money to be had on the table. We might block this offer. Again, there's a lot of details in the dynamics here, but it's just from a high level macro perspective, that can happen. And I've actually seen it happen where the company actually ended up doing well. They did the larger exit, but the founders were like, oh my gosh, I thought we were done, but we're done with this venture and we're going to get the exit. We're all going to, everyone's going to go buy a boat, have some fun, have a great, huge exit. But they were like, oh no, we've got to put, you'd think 3 more years, but you don't know if it's 3 years. You don't know what's going to happen in the economy. So it could be 10 more years, right? So it's one of those things that, and not every investor is going to say, oh, and only a 25% return, we're not going to take that. They may take it, but that is one of those unique situations where even if you're doing well and everything is going great, the timing of the investment may actually hinder your future ability to have an exit and future options, kind of like how Tom described earlier. That might actually limit your options in the future, depending on who you partnered with and who those investors are. So that's yeah, good. Did I answer your question or any
well, I mean, that's
a
critical aspect because, when you're taking the money, you're not really thinking of those kind of like smaller, minute details that actually become super important when the time comes and they matter. So generally, this essentially the decisions whether to be whether you be able to go forward with an exit, that would be limited to the shareholders and the boards. And so basically having a dual mindset, whether when it comes to taking on money in terms of what is the investment that's going to go into the company and what amount of control are you essentially giving off in return. Is that kind of the mindset to have?
Yeah, exactly. And it's also a control and trust perspective. So this is a really good segue of the first major topic here, the importance of investor alignment, because there's both control and trust that you really don't want to get into a situation. I'm sure this is like wildly obvious what I'm about to say, but you really don't want to get into a situation where everything goes to a vote. Every decision gets to a vote. Usually you want to build an investor team and a board that is generally aligned to what everyone wants to do, especially when you're early on. If you're having hard board votes and contentious board votes in the first couple of years of your venture, then you might want to rethink who you have on your board and who your investors are. But the first topic that I want to talk about when you talk about the importance of investor alignment is actually, instead of looking out at investors, it's first looking in at yourself. So who are you as a founder, or who are you in your founding team? Who are you from personality types? So consider, are you someone that, and there's a great article on this that's, decades old now, but do you want to be rich or do you want to be king? And that talks about, do you want to have the highest payout or do you want to keep the most control? And again, those are really binary decisions where I want to be king or I want to be rich. A lot of people think of, well, Elon Musk is king and rich. Jeff Bezos is king and rich. Okay, well, those are extreme outliers. But you want to consider where you fall on that spectrum and where you and your founders fall. And also, you want to understand why you're building what you're building. And so the better that you, the more you understand yourself, the better you'll be able to understand what you're looking for. And when you're looking for an investor, ideally you're able to be somewhat selective and look for someone that fits with you extremely well. And that's not just has the same viewpoints as you, but also when you look at yourself, you say, what type of exit are we looking for? What type of timeline are we ideally looking at? And then what do we bring to the table as the founding team? What don't we bring to the table? What are we inherently good at? And then what are we actually really not that good at? You don't necessarily need to share with the investors what you're not good at, but that'll then help you target who you actually want to have on your board and as part of your investment committee. So what I've found in my experience is that I've seen a lot of people take on investors that just bring a checkbook. And that's okay, and that can work, but you need to be the type of founder that has everything taken care of, where your investors are going to get the updates and everything just needs to kind of look good to them, and you're left to steer the ship and operate the ship all on your own. That can work, but in my experience, again, it's not the best way for you to engage investors. So there's a couple different things that I've found that people will look for when they're looking for good investor alignment from categories.
Steve, before that question, many people actually don't know when to engage investors. And in fact, in one of our most recent workshop this morning with Admiral Schofield, a lot of founders who didn't have their ideas too long ago, and they were starting to talk to an investor, which is way too early. What's your take on how can people start building that relationship early on?
Yeah, and that's a really good question. That one, I'll sound like a consultant here a little bit, but it does depend on your specific situation and where you're looking to fundraise. So if you've just got like an idea on the back of a napkin, right? Like not necessarily good to talk to investors right away. But if you're in that pre-seed stage, get yourself as organized as you can get, but you're always going to feel somewhat disorganized in that you can do more. What I would recommend is as you start to get to the more disciplined investors, think the angels, angel syndicates, and potentially venture capital, I encourage people to talk to investors as early as possible, but not about that you're fundraising today or tomorrow or next month. Talk to them much earlier than that. Understand that you have probably a 6 to 12 month timeline at least to raise money. And when you're talking to those investors, go to them and help them understand that you understand that it's too early for investment, but let them know that here's what I'm working on in the next 6 months. And after that 6 to 12 month time frame, that's when I'll be looking to take on investment because of X, Y, and Z. And what you're going to accomplish there is, one, you're going to have an open, low pressure conversation. For them, it's low pressure. For you, it's low pressure. You're not trying to get them to invest, and they don't have to decide if they're going to write a check or not. They just need to know if, hey, this might be interesting. Do I like this person? And then two, you start to establish a credibility and track record. So say Eric comes in, sorry to pick on you again, Eric. Eric comes in and talks to an investor and says, hey, we're going to try to land 3 to 5 customers in the next 6 to 12 months. But we want at least one of those customers to be a beachhead customer that's going to get us at least our first 6-figure deal. And say you said that 6 months ago, told an investor you're going to do that, and then now you've landed this 6-figure deal. Look at all that credibility that just built. People said, hey, Eric said he was going to do something, and Eric went ahead and then did it. And one thing you'll read online anywhere is that investors invest in people and they invest in track records. If you're a first-time founder, you don't have a founder track record. But if you start to build that micro track record just with that investor one-on-one saying, hey, I was going to go do something and I went ahead and did it, or at least did like 70 to 80%. of what I said I was going to do, then that trust level really starts to increase. So you basically turned what could be a relatively cold introduction or a cold outreach. In 6 months, you've turned that into a warm conversation where, hey, John, investor, I'm reaching out again. Just wanted to see if I could get 30 minutes on your time. Just want to give you an update of all the exciting things we've done, 2 to 3 bullet points on those things. Love to tell you more about it and how we're looking to invest or take on investment, excuse me. And so that's what I always encourage for folks is start those conversations early. Does that make sense? Anyone have any questions on that?
So we got a question from Marcin. Do you want to come off mute and ask yourself directly?
Sure. So a question is in terms of who you engage with when you talk to VCs. There is a spectrum of positions over there, and it feels like some lower positions in those VC organizations lead to a lot of discussions and zero tractions eventually until you actually talk to someone that is a GP, partner, principal. Then you actually start getting a dialogue and conversation. Do you have any thoughts, feedbacks on how to approach this space? On one end, you do want to engage with everyone. On the other hand, it seems like you have to be also conscious about the time and who you actually talk to and how do you build this relationship with the VC firms?
Right, great question. And on the VC side, this becomes a little more intricate. So when you're having those early stage conversations, unless if you know the principal or GP, I would be hesitant to spend too much time with those folks because, as you mentioned, their calendars are packed, absolutely packed, and especially in recessionary times like this, they're not as apt to go out and have those conversations because their checkbooks are getting a little bit tighter. They're doing a lot more diligence and they want to invest when the timing's right and it makes a lot of sense. So I would take it for the early stage conversations. I'd take advantage of those more junior level folks. Of course, I wouldn't necessarily, talk to too many first years if you can avoid it, because you got to understand their own personal motivations, right? So if you're, first year analyst at a VC firm, you want to just show that, hey, I had 30 conversations with early stage companies. They might be good in 2 to 3 years. Okay, check for their career, right? But if you can get in that associate, senior associate level, or even a junior principal, that those would be high value conversations to say, and again, establish a cadence of, I want to just introduce myself. I know you guys invest in say $1 to $3 million checks. And if you're, talking to a VC, they're probably going to do seed, maybe early Series A. So if they write, $1 million checks, we're going to be looking to raise $2.5 million, $2 to $2.5 million in the next 6 to 12 months. I want to introduce myself, let you know about what we're doing and how it aligns to your space. And then also let you know what our plan is for the next 6 to 12 months so that when we're entering that stage of readiness, we can then have a more detailed conversation on if this might be a good fit. But we wanted to first just introduce ourselves and let you know of our plan. You can accomplish that in a 15 to 20 minute conversation. And I would encourage you to do those again, that when you're about 6 to 12 months before entering that, hot zone of fundraising for about 2 to 3 months. Good question though, because again, you can get a lot of outreach from early stage folks. I even get it on LinkedIn when, if I've posted just, I'm working on a stealth startup in the past and I'll get outreach from, early stage VC folks. And I'm just like, I know you're just trying to get conversation. So again, use your own judgment on those, but look at if people are really early in their career, they're out of, just got out of their MBA, 1 to 2 years ago, if it seems interesting, have the conversation, but also let them know, hey, maybe I'm not ready. I'll let you know in 1 to 2 years when you are ready. So again, try to just have those early conversations, but just know your plan and know when you're ready.
Another concern funders have maybe they don't want to get to know VC for a long time and show that they didn't make a lot of progress. So they kind of avoid VCs and build, elsewhere, and then come back and say, hey, just in 3 months I built this, which maybe took them a year. How do you manage those investor optics? You talked a little bit about building relationships, sharing idea, but like, how can you differentiate building on the momentum versus building for a while?
So I'm actually going to take that in a different route. A lot of people like kind of think about like, how do I crack into that VC, right? And a lot of people just have conversations with junior folks, network into the VCs here and there. One thing that I actually try to tell people to do, if you're early enough, if you're in that seed, pre-seed stage, you're probably going to be fundraising from potentially friends and family, but most likely angel syndicates. I would use those avenues to start building that bit of credibility and getting introductions from that space. So if somebody's an angel investor, they're most likely, if you have, say, 3 to 4 angels that took investment in your company, if not more, they're most likely connected with somebody that operates in the venture capital world. So to have those conversations, I would actually use them and their network to help you get into that space. And that warm intro will start to build your credibility on your track record so far. So as you're building, and again, instead of going that route that I just recommended, you could go that route. Absolutely. If you don't have any other connections, make that warm intro, establish that credibility, or use your investors, which I would recommend even higher. Use your investors to reach out and say, hey, I invested in these guys or gals 18 months ago. They've scaled to this point to where they got their MVP in market. They've got a couple customers. It would mean a lot if you could have a conversation with them. We're looking to get that to that next level of the organization where we can start getting investment from more mature types of organizations in the venture capital space. I think that would be a better way to start building that credibility, and not necessarily looking to just have cold outreach to venture capital folks altogether. So I know that's kind of a different way to answer that question, but I would, again, focus on fundraising, building. And the people that you fundraised from after you've built, they should be more than willing to help you go out and find other people to invest, because that'll help their own investment and help the company grow. So I would focus on that and have those conversations with your investors early and often. A lot of people stonewall their investors a little bit and just tell them the minimum they need to hear. What I'm recommending throughout all of this is finding investors that can, one, know your industry, and then two, provide areas in skill sets you might not have on your team yet, right? Somebody that might know sales really well. If you're a B2B company, they're a B2B salesperson that's, in early retirement. Or if there's someone that's built products, say at Google or Apple or anywhere, they've built products or apps and they've done it before, and they could help you and guide you and engage in your startup. So that's kind of the crux of what I like to focus on when I talk about the importance of investor alignment. Because if you have the other type of investor, someone that just writes the checkbook, if you're building, say, a SaaS company, they might not understand that, okay, you get to MVP, but you have to keep building. And the costs of building are really high when you're building tech. And the returns are there, but they're there a little bit further out than if you're just building, a widget machine or something that's a little bit more of a hard good. So it's really good to have investors that know your industry, know your product, and know your selling type, so that, one, they can be on board with you to help you out along the way. But one thing that we talk about a fair bit in the book that I built with Charlene is the challenges that come. So whenever you face a challenge in your startup, those challenges that come, are your investors and board members, are they going to be there to help you create solutions? Or are they going to be there to create added pressure to say, hey, listen, I understand these challenges came, but we said we're going to hit production or MVP, by end of year. You said it's going to be middle of next year. What happened? Fix it. accelerate it, and you start making these patch decisions versus making decisions that are good for the long haul. I want to take a pause here, see if there's any questions that anyone has, anything that's coming up, any specific topics that people have in mind.
Yeah,
Sure,
I have one
Bill.
question. Can you comment on at what specific stage of the startup you talk to a angel investor or the VC? So, what's
Sure.
the
So
right stage?
I'll talk generally, and then I'll talk a little bit more specifically. So generally, pre-seed, and again, I used to these names and vernacular are useful so that everyone's on the same page, but they've changed so much over the last decade that it just depends on the dollar amount matters a little bit more now. So pre-seed, let's say up to like $400,000 or $500,000, you're looking at friends and family or some individual angels. Seed stage, again, say you're $500,000 to $1 million, you're generally looking at some individual angels, usually angel syndicates, where you can have somebody lead for that angel syndicate where they can write a slightly larger check. And then the Series A, we'll call that, say, $1 million to $2.5 million. They go higher, some people go lower. That's a decent range. That's where you'll start to see early stage venture is Series A. There are some that operate in seed, but again, that's usually on the larger side of seed. That's why I'm saying specifically the dollar amount value matters a lot more. So if you're doing a larger seed at like $2 million, you'll start to get some venture capital firms that'll write those $500,000 to $1 million checks. So, a lot of people say, well, VC's in seed all the time. Well, it's because seed's gotten bigger. But when you're below that $1 million mark, and again, you're always gonna have multiple investors in your investment round. That's usually where you'll get a lot of those angels and angel syndicates involved. And I highly, highly, highly recommend, if you have the opportunity to not need to raise a huge round, you'll be able to get investors in that are angels, and angels provide so much value. One, they're investing much more out of passion than venture capitalists are. And two, they're not beholden to a investment return schedule that venture capitalists are. It's not a hard, venture capitalists aren't necessarily in a hard return window, but there are in a window. It might be 5 to 8 years, 8 to 12 years, what have you. And, things get extended on individual cases, but they're not investing their money. Angels are generally investing their money, and there is a passion aspect out of it. And what you get out of that is, one, you sometimes get a slightly better valuation than you might have with a more traditional investment firm like a venture capital company. But you also get people that are much more willing to give you more of their time. And that's where that investor fit comes into play. You can get people that have industry knowledge, and you get people that participate on your board and not just check in once a quarter at your board meeting and say, why didn't you get as far as you thought you were going to get? You're probably checking in once a week with them, and they're helping to open doors, helping to really look around the corner for you to say, hey, I know where you're going. And oh, by the way, I know you've got, say, $500,000 budgeted to do X, Y, and Z. It's going to cost you $750. And it's better to be informed and know that something's going to cost more ahead of time than just you get there and it's a big oops. So I highly, highly, highly recommend fundraise as little as you can from friends and family, fundraise as much as you can from angels and angel syndicates, or like venture funds. Like Maine's got a really good venture fund that it is a venture fund that operates a little bit like venture capital, but it's mostly Maine state funding, right? So they operate kind of like a venture capital, but they're mostly like they feel like angels. So raise as much as you can from them, and then once you get large enough, then move on to venture capital.
Steve, we have a few questions.
Sure.
John, we'll get to you in a bit. One is, a lot of the investor conversation is only 30 minutes. How do you use that short time to figure out who is actually aligned with you and will be helpful for your business versus adding pressure to grow faster in the longer term?
So this one comes in the questions you ask and the questions they ask. There's a couple things that you can do to help expedite that process. as well as help optimize and maximize the time you have. Number one is have two versions of your pitch deck. This is pretty simple stuff, but got to say it anyways. Have a light version that you could send out to the entire internet and there wouldn't be any issues, right? Don't have anything too like confidential. And I'll get to something else that I want to talk about too. Nothing too confidential, but something that's like 5 to 7 slides if you're doing a pitch deck that could talk about your problem, solution, who you are, why you're doing it, why the time is right now. Don't even put in how much money you're asking in that. Just talk about problem, solution, your team, maybe a little bit about competition if that's really, really relevant, but that's not necessary. And then, why right now is the good time to build what you're building. And then in the meeting, get into your pitch deck. If they're asking a lot of questions about like, I don't know if that's a good problem, or okay, like they don't really understand your solution really well, that's a really easy indicator that they don't know the industry or they don't know the technology. They don't need to know both, but if they're asking a lot of questions about the problem and the solution, it's a pretty good indicator that, okay, I know AI is a hot space and I want to get into AI and these guys seem to know what they're talking about. So here's some money, right? They aren't really, if they don't really understand both of those, first red flag. Second red flag is if they aren't asking you questions that are pushing your thinking a little bit, like, oh, I didn't really think about it from that perspective. You don't need to say that out loud, but you can think it and say, oh, like I came away from that investor meeting and man, I might want to make some micro adjustments to my strategy based off of what I learned from them. So number 2 is I'd say, if you're not learning at least a little bit from them, then that means you're probably not going to learn anything when they're an investor. So those are 2 really easy ways to understand if they might be able to be that investor that adds a lot of alignment. And then the last one would be if they start talking about like terms and valuation, yada, yada, yada. If they start talking about those micro details in a first conversation, or like, I don't know if the valuation, that seems like a high valuation, yada, yada, that means they're looking to get a deal. So again, each one of those things individually isn't necessarily a red flag, but if you start to see those stack up, you might say, okay, this person's just looking to get the best deal they can, and they want to get into my space, the space that you're operating in, and they may not understand why they're getting in and may not be able to add a lot of value. But again, something that we talk about in the book here is if you meet an investor and you don't negotiate and they don't negotiate, that's also a huge red flag. But you shouldn't really hear those negotiations in that first 30-minute meeting, or even if it's the second one where it's that first real meaty meeting, whether it's the first, second, or third meeting, what have you. I wouldn't necessarily expect to see much negotiation there. But again, they want you to negotiate because they want to see that you're a good negotiator, and they're going to negotiate with you. If that's not happening as you get closer to doing a deal, that's also a red flag that I'd see. Sounds like we got some more questions, Charlene.
Yeah, Steve's book is great. We'll share a link of that to everyone afterwards. We have a question from Mariana. Her question is around, you mentioned finding alignment at early stages. So she would like to hear more about your ideas around how to find strategic angels to partner with early on.
So that's a great question. And again, what we talked about earlier is like taking a step back from the macro and then moving into the micro. So taking a step back from the macro is from a kind of like a sales perspective, because you are kind of selling them on your company. You're selling on them to invest with you. And one of the things to remember is angels, angel syndicates, and even venture, especially venture capitalists, but let's focus on angels and angel syndicates, is they want to invest, right? They're not doing this to, maybe I'll dump my savings out and invest in this, right? That's maybe where friends and family conversations will be. But with the angels, remember, they want to invest. So you'll specifically want to look for angels that are in your space. And the reason that I'm saying they want to invest is they also want to be found. They want to look at deals. They enjoy doing this. Most of them aren't doing this as like a hard, business or job. They're not This isn't their 9 to 5. They're doing this because they want to make investments and they enjoy the process of making investments. So they do want to hear from you. So it's actually quite easy. And there's a number of resources out there to find angel groups and angel investors. And they're usually pretty easy to network into, especially if it's in your local area, to at least get a conversation with someone in the angel group. And then if you can get past that, then you'll get through to that larger group to be able to do a formal pitch. But the question was around, how do you find those strategically aligned folks?
A quick follow-up from Mariana. She says she's looking for more tactical standpoints as to like where to look for them. Maybe what sites, what link, what events, where.
Yeah, absolutely. And I can share some specific ones, but usually one that I like to do is that's nationwide, that actually I go to the one here, and I'm in Salt Lake City right now, but I go to the one in Boston, Salt Lake, and in a bunch of different areas. But 1 Million Cups is a good space to go. They let you do soft pitches, but a lot of investors show up that are angel investors. And so those events are good in-person events where you can go and you can pitch. You're not pitching for anything, you're pitching for feedback. But usually investors show up there. And then I hate to say it, but simple Google searches, there are a couple websites out there, but it's usually venture capital. And I can have a link that Charlene can send out to the group with a couple links to websites for you guys. But it usually those are just, you'll find the name of them and then you end up going to their website and doing research anyways. But usually just look for angel groups, type in your area, and then look through them and do your research to understand who's in my space. Or if I'm in ed tech, if I'm in biotech, what have you, who's in that space, and they'll be very specific about what they're looking for, because they don't want to take a pitch from anyone. If you're in biotech or health tech, or they don't want to hear about your B2B SaaS security marketplace. They don't care, right? That's not where they're investing. So they'll be very specific. And that's one of the things I really do recommend is do your investor research before you reach out. Don't just send a bunch of outreach to, I'm looking to fundraise, here's my company. I'm looking to fundraise, and here's why I think you specifically would be a good angel group for me to consider taking investment from. And do have a little bit of that confidence as well. Not saying, can I pretty please pitch to you guys? This is why my company would be a great company to add to your investment portfolio. And here you can list out the reasons why. Like, you can even look at, they're happy to show prior investments. A lot of these have websites. A lot of the angel groups have websites. But again, it's just a little bit of that grassroots networking. But I can again share out a few links to some websites that just show, location, angel group location, typical check size, and industries that they focus on.
We have a question from Tom around term sheet and negotiation. So the question is, what are the most important terms to negotiate, and how wide is the range most VCs will negotiate on those terms if the goal is to remaining king?
Okay, got it.
So set aside valuation is a term. What are the other terms?
Yeah, right. So in my first question was, well, it's going to be depend on if you want to be that king or rich perspective. Sounds like you want to be on the closer side of the king, and more so keeping in control. So there's a number of things you can negotiate. Again, the one that usually comes up is like valuation, and then that valuation in relation to what percentage equity that you're going to give up. There's other things that you can do, such as, board seats, board votes, and things that can be voted on, right? So as you get into a term sheet, some of the more micro things that can or can't show up is, if you're the CEO, what do you need board approval for, right? What's the dollar threshold of spend that you need it for? What type of hiring do you need board approvals for? And then also, what types of shares are people going to get? Again, if you want to be king and really stay in control, you can do things such as you can do like a preferred shares that are non-voting, but they get like a preferred 15% return or like 5% return annually. That stacks up, right? But you can see as that stacks up year over year before you exit, that's their like investment. We can call it, like, say it's, they invest $1 million and it's a 5% return, doesn't get paid out, but just gets stacked on. Their ownership of the company is going to go up. They might, and someone may be willing to do that and give up their voting shares or half of their voting shares or what have you, to be able to take that on. Again, this is like a control and trust type of thing where, again, if you're getting into something like that where you're going to say you have no voting shares, that trust went down to zero, right? Like, so one thing that you could think of is, what specifically will be board voted on and who's on the board, right? So if you're on the board and you have someone else that's your board chair that you trust a lot, if it's a board vote and not a shareholder vote, then you can control those votes a lot more, right? So that's another way that you can do it, but also something to watch out for that VCs slide in there. And again, this is why I like angels a lot more than VCs, and nothing against VCs, but they're a business, right? Angels are investing money, their money. VCs are investing other people's money, but VCs like to slide in there, that the co-founder shares will have a vesting reset, right? So that your shares, whatever it is, say it's 70%, are on a vesting reset where you're now on a 4-year vesting schedule when you sign that term sheet, right? So that's something to also watch out for, is they might say, yeah, sure, we can do those board votes and whatnot, but we're going to do a vesting reset. And so that, you know what I mean? If we're going to vote you out as CEO 2 years in, you only keep 50% of your shares, which is, again, something to watch out for. Not all of them always do it, but usually when they do it, they have some sort of precedence onto why. Like either there hasn't been a track record or you own too much of the company, but that's something else to watch out for. But again, on those term sheet negotiations, things around voting and what's voted on and where and when, some of it's hard set, but again, this is your company. You can kind of run it how you want to. It's just, is the investor going to agree to it? But again, we could extend this for 10 hours and not get to the bottom of it, right? So feel free to, and Charlene's going to share my LinkedIn and some of my contact info. Please reach out with very specific follow-up questions after this. And again, as we mentioned, there's a book out there that we created that goes over all of this and more. That highly, one ask I have of everyone, if you could please at least go check that out and take a look. We're looking for feedback, and we're looking for any ways that people can get more involved in this process. Because again,
yeah, and also the book is amazing. We have one more question from Marcin on pre-seed. So he asked, an investor offered little cash and the rest in advisory shares. So just some cash and a lot of advisory shares, claiming that they will be building syndicate. The question is, what could he do about such advisory quote unquote share offers?
So I wouldn't necessarily, so this was pre-seed, right?
Yes.
So pre-seed, you shouldn't be handing out any shares to anyone. And the reason for that is, I mean, you're just far too early. If somebody's doing what's called like an equity-based fundraise or valuation-based fundraise, where you're actually handing equity out, you're far too early. If you're pre-seed, I'm assuming you're pre-revenue. And maybe you have revenue, but still, if you're pre-seed, I would be using a tool like a SAFE or convertible note. SAFEs, for obvious reasons, are a lot better. There's no, debt interest that comes with that. I would just do it as a like 50% cash, 50% like advisory. I'm not saying definitely do this, but if this is something you're willing to do, you could just do it as, give me $50,000, and then I'll give you another $50,000 of SAFE money to then add to that. So to kind of go into some detail on that, how you could structure it is, and I've done this as well with people that, all right, I'll do something for some promise of future equity. I'll do some consulting for you or whatever, but it'll be worth, say, $50,000 of instead of you paying me, just give me 50,000, a safe worth $50,000 at a future conversion, right? So you with safes, you have a future conversion with a valuation cap of say $5 million or $10 million. So whatever you would use that as a safe for 50,000, give them whatever amount of shares. If it's another 50,000 or another 25,000, just give that to them in that safe agreement.
So I think to clarify a little bit more, are you leaning towards taking this offer or not taking this offer? Because based on your phrase, it's a little bit unclear.
Not taking, because I'm not even sure what they're going to be advising on, and I'm kind of actually not even sure if those advisory shares are really necessary to be given if they claim to start building syndicate and bringing more people ahead. I mean, it's kind of hard to find something on the internet about advisory shares, so it starts being like, a red flag all over it. So obviously, I'm leaning toward no.
So advisory shares are quite common, not this early, but they are quite common. And the part of the reason for that is you can like build a board of advisors, not a board of directors, board of advisors. They're like people that might be a board. They might show up to the board meetings and be a board observer, but they don't have any voting rights or anything like that. But it's someone that would be really useful to have in your back pocket, right? Somebody that might be able to get you connections or maybe get you to investors. What I've seen people do in the past is do, contingency releases, right? And the reason why shares are really tricky in the early stages, if you're incorporated, like you might have like 100 shares, right? So like, what are you going to give them? Like one share or half a share? Are you going to create a Carter account to be able to actually like formally issue those shares digitally? That's a lot of work to do just to give somebody a promise of advisory shares. Again, what you can do from that safe mechanism, you can take that 50,000 if you wanted to do this, take that 50,000, have it in a safe, have it in that safe agreement that can convert, and then let them know that every time they bring on an investor and an investor actually writes the check from their intro, you'll give them another 50,000 or 20,000 of like safe money, meaning they're not giving you money. You're not giving them money. You're just adding to their safe value so that you can, when you do a priced round, that money will convert for them, right? So they're investing 50,000 and say they intro you to 5 investors that do invest and you give them 20,000 worth of safe money each time. They're now safe money that'll be 150,000 and that'll convert at whatever the valuation is when the safe converts. So that's, if you were to do this, that's the way I would do it. I would do it contingent on them making introductions, in those introductions investing in your company.
So building in that conditional clauses to protect. And I just put Steve's LinkedIn in the chat. We're running out of time, so feel free to connect with him. We'll send out a link to the book. Feel free to check it out. And thank you, Steve, for coming, joining the Xoogler, and sharing your wisdom with us today.
Absolutely. And thanks everyone for your time. I really appreciate it. This was a great, engaging conversations. Again, like we could spend hours and days talking about all of these topics. One thing I do want to mention about the book is no matter where you are, the way we structured it is that if you even you're before fundraising, you can go through the book and kind of be able to see around the corner a little bit. But the way we structured it is each, chapter and segment, you should be able to go really deep on where you are now. And it should help you get to the next step, whether you're doing pre-seed, seed, Series A, so that you can get to that next step and then maybe put the book away for a month or a year and then come back to it when you're at that next stage and being able to again help you progress and bring back to the book. So I just wanted to thank again everyone. Thank Charlene, thank the Xoogler community. This has been great. And if you guys have interest in future topics or more things, I'd love to come back to your community and do this again.
Thank you, Steve. Thanks, everyone.